Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
Well, I think we're kind of on blow up on your face watch right now, Double A. There's a lot going on in the world. We're recording this prior to the market open on Monday, but after the Iranian attack on Israel. And while I think it was pretty clearly hey, we're attacking. Hey, we want to make sure we give you as much notice as possible. We're attacking. We're attacking. You are going to shoot all these down, right? The fact is it happened.
Right, it did.
Yep. So I know that Bitcoin, I know some YouTube influencer was all over YouTube yesterday talking about Bitcoin collapsing. Does that trade through the weekend? I just don't know enough about crypto.
It does. And preface by saying I am not a crypto expert either, but I do know that it trades around the clock. So you could jump in and look at Bitcoin futures yesterday as these events unfolded. Yeah. Yep.
So they were collapsing. And there's a guy that I recommend because I sort of have a crypto block. If you go to stockcheatsheets.com, there's a few traders I recommend. I recommend you and your mortgage company, Double A.
Thank you for that.
And I recommend this guy. You'll have to forgive me. I don't know the name of his company off the top of my head, but he's really good at it. And so you can go to my blog, and it's the only crypto blogger that I recommend.
I haven't seen that. I'll go look for him this afternoon.
So what I wanted to do today, for those of you who subscribe to my YouTube channel, all four of you, I know it's been months since I've done an update. I'm going to start trying to do the video updates again because I do get occasionally, especially from the folks, paying me for the recommendations, is that, as much as I link to explanations of what factors are driving cheat sheets, the point is you can never explain it enough because we don't try to create just one easy green light, red light button, right? There's a lot of different technical factors that go into when stocks are moving to complement our time frame. And you, of course, I should mention that Double A is you're in the middle of your CMT education. You've actually passed the first bar and have a couple more to complete, but we're going to be relying on you as our pseudo chartered market technician. I guess we need to be clear. You're not officially licensed yet. But we've been doing this together for a long time. In my opinion, you are. You know what you're doing.
Thanks, Mike. Yeah, I'm in the process of trying
making it official,
trying to obtain that CMT designation.
So what I'd like to do is kind of go through the cheat sheet stuff and then throw it to you for some backup. We're going to start with the major indexes. So I think I know what I'm doing here. Okay. But we may have an occasional snafu, and just remember, it's just, is it the green button or the red button? But I just want to make sure you can see right now what would be our market conditions forum at cheat sheets, stockcheatsheets.com, market conditions forum.
Yep.
And when we say we're very bearish, I want to be clear about something. From a technical standpoint, the market is definitely consolidating, but I think we would argue that based on the traditional things we would look at, we couldn't call this a bear market.
No, and there's probably a difference, and I know there is, between not initiating new positions and initiating short positions.
Right. And so you have to remember that my version of very bearish is for the particular strategy the cheat sheet serves, which is trend following that turns around within the year. All right. So this is, and I think I've been pretty clear about this. This strategy I don't use for my retirement. If I had to save up for my kids' college education, I wouldn't be using any of these strategies, right? This is what I like to call my funny money strategy. Mm-hmm. It's the money I've set aside. And of course, I talk in terms of stocks. What I'm really doing are trading options. But this is my funny money in order to pay for things that otherwise, as a middle-class slob, which is all I am, that it gives me the chance to live for a couple of weeks at a time at the upper end of the threshold. Does that make sense?
Yeah. This finances your annual or twice annual vacations and things like that.
Yep. And I've been very clear. I bought a luxury cruise on a line. I would never pay real money for this experience. It's like, I think normally I did get a deal, but I think it's like $1,000 per night per person. And it happens to be going from Lima, Peru to Panama. And I'm very interested in Panama as a potential expat place to go to retire, which I'm going to do this year, it looks like, at age 60. And so it was just a chance to use some of the gains from this colossal 7-month market rally that appears to have come to an end, at least temporarily, to overpay for these indulgences. Yeah. And so after taxes, I was able to do that, and also fund my broken leg in 3 places. So that's where my money went to this year, and I basically got out of most stuff as I've been watching the cheat sheet metrics decline. So I actually do eat my own cooking here. And so with that as a background, we're looking at a cheat sheet's proprietary metric called the Tailwind Score, which is actually a composite rating based on, I think you'd argue, AA. There's nothing fancy about any of the indicators that I use to go into this. It's a combination of actual trend metrics and what we'll call oscillation or accelerator metrics that speak to the momentum and allow you to extrapolate as to whether or not over our weeks to months time frame that it's a good time to be initiating new positions.
Yeah, it's not the ingredients, it's a combination of the ingredients.
That's right. And so and I've tinkered with the weighting over the years, long before we made this public, and this is my kind of proprietary pole in the ground, so to speak. So it's an early warning system. These metrics always go bearish before the market reverses, and they tend to get a little brighter. Although no, I would say that when the market reverses from a bottom, these tend to lag a little bit. So I always teach which of the 10 factors that, so the 10 factors that are most important when we're doing what I like to call climbing a wall of worry. So after the sell-off, the tailwind score generally is lagging. And so there's a few metrics you have to look at to make decisions about whether or not to get back in, because the tailwind score will keep you out unless the market is trending, the forecast is for more, there's good buying pressure or money flow. We use those two terms interchangeably, and that there's decent relative strength against the total market. So that's like the price for perfection. So while the rally began in October, maybe mid-September, these metrics didn't turn fully bullish, meaning above 60, until probably early November. But there's ways to catch the way up earlier. You're just taking more risk, right? The less information you have, AA, the more risk you're taking.
Life's about trade-offs.
Yep. And so you want to look at these indexes individually. And obviously the SPY is sort of the one that most people pay attention to. That's the S&P 500 large cap stocks. And right now at a 33% tailwind score, you'll see that I'm just going to go through this once to explain the tailwind metrics, and we won't do it again.
Okay.
But we're in a long-term trend and an intermediate-term trend. And for the metrics, it's very simple. Is the 10-week moving average above the 40-week moving average? The answer is yes. So we say bullish. Now that's even when there's a consolidation, meaning if the last few weeks have been down and the moving averages have flattened out, we'd still call it bullish. The long-term trend is that basically the shorter-term moving average is above the longer-term moving average. And then your intermediate trend would be the daily version of that. So it's the 10 over the 40. And then short term, I think on this one, I use the 10-hour over the 40-hour. So this is your pullback metric. And what it's showing right now, at least, is if you just were to rely on those metrics, that we're in a long and intermediate uptrend, but we're pulling back or consolidating in the short run. However, there's other things we add to it. And so I would say that from factor 4 on, we start to get more into leading indicators. So the next one is buying pressure, factor 4. That's really, I put an asterisk by that one. I think you and I would agree that Chaikin money flow, which is what drives my buying pressure rating, is probably one of the more important metrics out there. I know you've got a couple of other ones that are like it that you use.
Yeah.
You've been using something called Force Index.
Force that right? Index. Yeah, yep. Which is, it's also just a measure of momentum.
Right. And so money flow basically equates where you closed, where the candle, the daily candle finished relative to the high or low or not, and the volume. So, if we're finishing up at or near our highs on high volume, that helps money flow. And when we are seeing closes at or near our low, particularly at high volume, that hurts money flow. So it's a price volume indicator, and it's a 21-day rolling metric. We're using it as a snapshot in time, but it's best looked at also over time, right? It's about the persistency of money flow that matters as much as any individual snapshot.
Okay.
But bullish or very bullish ratings means that we've got a money flow score of a Chaikin money flow score of 0.1 or higher. Very bullish would be 0.2 or higher. And I would argue that once you're in 0.2 or higher, institutions are buying. They're right along with you for the ride. They're driving investment in that particular direction. And then we have relative strength. And I want to be sure everyone understands this one. We're doing relative strength against the broader IWV ETF. So that's the Russell 3000. So when we're saying we're underperforming the IWV, which in this case we are, just slightly, neutral minus is ever so slight underperformance. That's just relative to the overall market. It doesn't mean we're necessarily losing RSI type strength. So this would be comparative strength and not absolute strength. And then we have a series of momentum indicators. And I'm not going to get into all the nuances today. Just from a pure intermediate trend following system, you can skip right to factor 8. And unless you see a positive metric, neutral plus or higher, it pretty much says set on your hands in terms of doing a long trend following strategy.
Okay. Yep.
Now, the long-term forecast is still good. And so what that is telling you is that right now we're in the middle of an intermediate consolidation. That's a weeks to months correction. And when the long-term forecast is very bullish, under those circumstances, when you're seeing the junior time frame slow down, which we're clearly seeing here, right? We were still in a trend, but the intermediate forecast is bad, and we know that we're pulling back. We know the short-term moving averages at least have crossed negatively. But when you see the long-term moving average holding in there, there's a better chance than not that after consolidation, we'll return to a bullish posture, right? The odds are better that there's still more to go out of this rally. Now that can change. And so we want to watch that long-term forecast closely, because once long-term and intermediate term are both in agreement, I'd argue we're in, and my definition of a bear market is the trend on the weeks to potentially months level is lower, right?
Okay.
So very bullish for now on the long-term metric. That just means we're above 80 on a 0 to 100 oscillator. And when we're above 80, we don't care what the direction is of the long-term oscillator. And then the near-term forecast, and I think the most important thing here is how I use that is whenever it turns red. Because what it's telling you is that the selling momentum, either factor 9, which is a swing trading time frame over a 2-day to 2-week time frame, or the momentum time frame factor 10, which is it's the day trading, day or two momentum. When either of those light up red, it's telling you that the shorter term investors may be doing more than just selling. They might actually be loading up on some short positions. And so for me, it just becomes a warning that underneath the time frame that I care about, there's maybe more selling going on than simply a light volume pullback. So Friday was a pretty ugly day in the market, wasn't it, Double?
Yeah, both Thursday and Friday, from what I recall.
And to be honest with you, I'm not sure about Friday. We're gonna or Thursday. We're gonna look at your stuff next for these major indexes. But the fact is, we didn't have at least not a sustained momentum flashing red, either heads up, which is, we barely missed overselling to the point where you should be concerned. Heads up is more of it's not a disaster, but I always say that if you get a heads up, for example, on the DIA, there was enough selling on the shortest term momentum indicator to suggest that I then need the next day for stocks to close above the high of that down day in order to feel good about the prospects for a continuation of a short-term uptrend. Whenever I get a heads up, I always say I will not trade anything that is otherwise meeting my trading conditions at the open the next day. I will wait till the close and make sure there is no selling follow through. So a heads up is there's a chance for some selling follow through. Wait until the end of the next trading day and make sure the momentum has switched. And there's one worse for either factor 9 or 10, and that is when you see a danger. A danger reading is that you're in you are in the lowest 5% of the measurement of trading selling. And when you get that, the odds are much more likely that the selling follow through will continue.
Yeah.
And so that one, you need sort of a different type of proof. You almost want to wait for the short-term trend to reverse.
And anecdotally, selling on Friday, like we saw on Friday, is usually followed on Monday.
Yep.
Right. Just historically.
Yep. So the one thing we didn't pick up, and I'm the first to tell you, when we do, I pay attention to it. We did not have that momentum crash down to that lower 5% on most of the indexes. Well, none of the indexes got below 5 on that 0 to 100 oscillator number. However, the selling has been enough to roll over the intermediate market forecast. So it really doesn't matter, right? Maybe it didn't happen in a day, but over the course of 2 days, we now have no positive intermediate forecast left. So the odds are better than not that we continue lower as of this moment.
Mm-hmm.
With maybe tech as a potential exception, the data is mixed on tech right now.
Yeah.
I mean, in the Qs. Yeah. But why don't we? So that's what Cheat Sheets is telling us, that it was not a disaster on Friday, but it's been enough of there's been enough selling over the last several trading days to where now the numbers are very bearish and sit on your hands as far as bullish equity trades in the U.S. market. Yeah. Fair enough?
Fair enough. Yeah.
All right. So let me pull up your stuff here. And you'll have to tell me if you're able to see your stuff now. I don't have control over it.
I am able to see it.
Excellent. All right. So why don't you walk us through it? And I'm just going to enlarge my screen so I can see it better.
Okay. And I'm going to go back to
start with the major indexes. I think we all know that the Russell is underperforming. So you don't need to cover that one if you don't want to, but we should look at all the large cap stuff.
Okay. Look, for the indexes or the futures?
Indexes or the ETFs would be the best. Because that will correspond with cheat sheets. I know you look at futures.
Yeah, I'm not even sure I have them here.
Well, then just do the SPX.
There we go. There we go.
And all of this is the same. There's subtle nuance differences between them.
Yeah. Let me get rid of some of this stuff here so we can see a little better.
Yeah. So you're actually showing a market forecast on this screen. And while you're optimizing, I would just say that for the SPY anyway, we have not had a dip into that 5% disaster zone, not since the week, or it looks like maybe April. It looks like it's been a while.
A week or so, April 4th.
Yeah. So despite the downturn, we haven't gotten that massive sell-off that would tip the momentum into that real danger zone area.
But what we have got is a series of lower lows.
Yeah.
On the blue line, which is intermediate, I believe.
Yep. Sometimes when institutions are sneaking out of positions, you get that. You get the same outcome as you would if people just puked up stocks over a day or two.
Yeah.
Yep. Yeah. And we see that on cheat sheets in the form of money flow, which was in the, we were in very bullish money flow. Then it kind of went to bullish, and then it went to neutral plus, and now it's hanging around zero, and some is even under liquidation. So we've been seeing institutions for the last 5 to 6 weeks sneaking out of positions, taking profits on stocks very quietly.
Yeah, we're also at the lower volatility band.
Yeah. And what do you set that up? Is that 2 ATR around the 21-day moving average, or what are your criteria?
Yeah, I use this the stock setup for the Bollingers.
Got it.
Yeah.
And so you're a 21-day exponential moving average, and then you have a Bollinger Band, which is basically a standard deviation above and below that 21-day moving average.
Right.
And so what are you seeing now as a result of that?
Bollinger Bands, while the band can, turn south and price can ride it down, it also tends to oftentimes act as a bit of a point of resistance.
Or support.
Support. I'm sorry. Support. Yeah.
And it looks like we've been pretty weak since it's hard to tell on the time frames, but it looks like for most of the month we've been pretty weak on the S&P and generally trending down in what I would call a short-term to potentially now transitioning to intermediate pullback.
Yeah, just because of the time frame.
Yep.
Yeah.
And then the Qs started underperforming. I would say they hit their peak in late February, maybe early March, something like around there. And then we've been kind of sideways. We haven't necessarily been going straight down, but we've been sideways consolidating for a while.
We have, and momentum has been slowly coming out as the RSI
Yeah.
has achieved lower highs each time.
And as I've been explaining to people who may not be as familiar with that indicator, think of it like a baseball team going on a winning or losing streak. So the more games out of 10 or 20 that you win, the more impressive it is, but the more the probabilities kind of switch on you because most teams can't keep up that kind of frenetic pace. And so once you get an RSI above 70, it can stay there for a while, especially with a really good team. But there's a chance that we're going to hit a losing patch relatively soon. And the RSI is tracking, I believe, the most recent 14 days, either going up or going down. And the more days in a row you get, or the more days out of 14 you get, the higher the RSI is.
Right. Yeah, it's 14. Yeah. You're right.
Yeah. And then the opposite is true. So, traders use it in a lot of different ways to time entries, the way we use the market forecast, just a different way to do the same thing.
Yeah, and it also tells you the strength or momentum behind the trend, because if you're achieving, look for those divergences we talk about all the time, higher highs in price, yet higher lows in RSI, that's a flag to watch.
And the RSI very clearly is trending sideways to lower.
Yeah.
As are the stocks above them.
That's right.
Yep. And so tomorrow we may get, I guess it really now depends on what Israel does, but it seems to me like geopolitical is going to jerk stocks around here for the next few days, for sure.
It does. But that might be, and I don't know if this is the right.
And then we have another one we'll talk about in a second, but I would say Monday's open may or may not be impacted by what happened over the weekend.
It may or may not. And I was going to say this, I don't know if this is the right way to say it, but geopolitics may be putting the inflation story on the back burner, which could be a good thing also.
Well, that would be, I think, the second thing. Talk to me about the two reports. I blogged about this in Cheat Sheet, so I don't need to give my rambling spiel again. Mm-hmm. You can go look at this weekend where I give the days and the times for the two key reports that I think will inform the Fed's rate decisions moving forward.
Yeah, are you talking backward looking? So the ones that we just...
We can do the ones that just happened, and then there's a couple coming up this week.
Yeah, so the CPI obviously was last week, and it was about a tenth hotter than most forecast. And I've looked at that pretty extensively, and a lot of that comes down to one single component, which was auto insurance, believe it or not. Although shelter remains high, and I could go on an hour-long, narrative about why shelter is high, but it remains high. It hasn't come down the way most people thought it would.
And while you're talking, pull up the IWM, because I think we'd agree that is the collection of U.S. stocks that are most affected by inflation and by high rates.
Yeah. And there you can see, I mean, we talked about that before, that false breakout a few weeks ago.
Yep. I got out. I got in, got out. And I made money, believe it or not.
And now also testing that lower volatility band. So
yeah, you could argue it looks like we did put in a lower low on Friday.
It sure does.
We kind of broke there, and the market forecast
is below that 5 level.
Yep, and the market forecast is it below the 5 level?
Yeah, the near term.
So the green area, the near, you mean the momentum line, which is red, I think.
Yeah. Actually, let me look.
Momentum finished 10 on Friday.
Okay. You're right.
However, the green line, which is our intermediate time frame, cheat sheets would translate that into bearish. So the only way it gets worse is if we get below 20. Mm-hmm. Right now we're at 30. We're at 30 on the green line. And it would be a bearish intermediate forecast. It would go from bearish to very bearish.
Right.
Once we're there, and that means the selling would accelerate. But as of right now, the odds are we're headed lower from here.
Yes. Yep. That's what the odds say.
So back to the economic data. Yep. So we had a hotter inflation report last week. And how is that going to impact the Fed?
Well, the market's already telling us that, they went from the 3 rate cuts that they've been trying to hammer that are going to happen. The market is now priced out one of those. So it's pricing in 2, but it's also kicked the can further down the road into September.
Right. So we had been expecting rate cuts, and a lot of the stock market rally has been kind of anticipating easier Fed policy moving forward, but that's starting to unwind now.
Yes. And my suspicion is it's going to continue to unwind.
Yep. Yeah. Now, you talked to me about something interesting, and I would say that before we get into it, though, tell me what investors can expect in terms of new inflation data coming up in the next few days.
So I know if it's either, I think it's next week, the week after this coming week is the PCE, which is
and so there's the PP. There's a producer and a consumer version coming up, I think.
And the PCE is the one that the Fed supposedly pays more attention to, but it's
and what is that PCE? What does that stand for?
Consumer price expenders.
Basically, it's an inflation report.
It's an inflation report, right? But it's calculated in a different way than the CPI. It has different weighting.
Got it.
But it's made up mostly of things that are already known, so you can reverse engineer it and kind of do the calculation ahead of time, which people have done already in the marketplace, and it's showing that it's going to show a slower pace of increase in inflation compared to the CPI. So might be some help for the bond market when that hits, although it's already mostly widely known.
Yep. And while you and so you were then going to explain how the Fed kind of has two ways that it can stay a little bit more aggressive in terms of rates. In other words, I guess it could always raise rates. But even if it were to cut, there's something else going on in the background that most people aren't aware of that the Fed is quietly doing.
So since 2022, when they began this program they call QT, quantitative tightening, they've basically been allowing all the assets on their balance sheet. So the treasuries that they've bought over the years, the mortgage-backed securities that they've bought over the years, all of these things are timed instruments, and as they either expire naturally, or in the case of like mortgage-backed securities, if somebody pays off a mortgage, they're basically letting those things roll off naturally. So they're taking that principal investment back and not reinvesting it.
So the Fed had bought a bunch of assets during COVID to artificially prop up multiple markets, not just the stock market, but the bond market as well.
Trillions, right?
Yep. And the reason is because they don't want the U.S. government to have to, because we're borrowing like drunken sailors and have been for decades. And so a high interest rate is horribly impactful for U.S. debt service, among other things.
Right. So anyway, now they're talking, and you're starting to hear this a little bit in headlines and in the news, et cetera. They're talking about, the Fed is talking about in the coming months, and it seems like it's pretty much a done deal. It's just a matter of when. They're going to reduce the pace at which that balance sheet rolls off, meaning that when, treasuries go to term and that principal investment comes back, or mortgages, actually mortgages are a different thing, so I'll leave that alone for a minute. But when those treasuries are paid off and that principal investment comes back, rather than not reinvesting any of it, they're going to reinvest a portion of that back into the treasury market, whether it's 20% or 30% or 50%. I mean, I don't know, and I don't know if they know yet, but that's generally the idea. Mortgages, though, and
so before you get into mortgages, so this will in effect, because right now they can't ignore inflation data. But they also know they have to be concerned about tipping the economy into recession, right? It's almost an impossibly hard landing with inflation now persistent. They can't start cutting rates. But what you're suggesting is maybe what they'll do is quietly cut rates in a different way, or at least not allow them to go up much further.
Mike, honestly, I don't even know. I don't view it quite like that. I view it more like, I mean, you and I have talked about this extensively, is that everything has been driven by liquidity, right? So liquidity is beginning to dry up as the RRP, the reverse repo facility, draws down. I know that's a whole other conversation.
But the bottom line is, just to keep it simple, it's the cost of money.
Right. Well, it's the availability.
Availability of money.
Right. So
the more scarce the availability, the higher the rates go.
Right. Because as they issue all this debt they have to fund the government, I think a big fear is that one of these treasury auctions will just fall flat on its face with no buyers. So if the Fed,
if nobody buys our debt,
right, which would, like, that would be bad. If you remember when the pandemic first hit, the treasury market seized up and rates shot to the moon. Like, they don't want that to happen. So by the Fed slowing the pace of its roll off, it becomes a buyer at those auctions for treasuries at some point in the near future. So
we're not even talking about moves to cushion the average 401k investor who might be nearing retirement like me. We're talking about a different kind of thing. It's staving off Armageddon.
It's defending the dollar, right? By all of this financial engineering.
So rather than doing too much of a deep dive into macro, let's keep going, because we can actually kind of watch what the traders who have access to people like you and other analysts who are macroeconomic specialists, we're able to kind of see that through the what's being acquired and what's being sold. And you can see here, and this has been true for a while, the DBC, which is sort of a parent ETF that essentially holds futures contracts for a lot of different commodity categories, right? Like energy, agriculture. I don't think they have, correct me if I'm wrong, I'm not sure they get into bonds in the DBC. I think it's all hard intangible assets.
I believe you're right, but I'm not going to pretend I know that for sure.
So DBC is not, the futures market is the best way to absolutely look at how commodities are priced. But the DBC is, I think, a good relative tool because you can use it as an ETF and then compare it to a lot of other ETFs. And what we're doing here is showing you that, yes, the tailwind metrics are not quite huge. There was a big reversal day in gold and silver. I think that explains some of this on Friday because we've had DBC in the 50s here. But this is what I mean about commodities or any cheat sheet tailwind scores kind of lagging the reality. And what you'll see here is the most important things are the reason this score is getting hit is because the commodities rally, and particularly in oil and precious metals. That's really where it's coming from. Is relatively new, right? It's only the last month, maybe 6 weeks, we've started to see the rotation into that stuff. And so the long-term trend, or factor number one, that's the 10-week moving average over the 40, that hasn't even kicked in yet. So that hurts the tailwind score. Relative strength over a 3 and 6 month basis against the broader stock market. Yeah, maybe the 3 month is getting better, but we're still underperforming because we're looking back 120, or 60 to 120 trading days, or 3 to 6 calendar months. So that's going to hurt the score. And then we have the long-term forecast, which is, you have to get all the other oscillators moving in the right direction before you're going to get long-term forecast in. So this is an example where that 42 score is a little bit misleading for an intermediate trend trader, because all you need to do is look at the intermediate forecast, that oscillator that measures weeks to, weeks to a couple of months. And then the buying pressure, which is Chaikin money flow. Both of those are tipping the scale at the kind of the highest quintile that we can measure. And so we know that the market forecast and buying pressure together are telling us we're in the beginning of a trend. Now, again, the fewer metrics you have confirming that, the greater the probability is the trend is going to fail or be suppressed, right? There's still a lot of things that can last a few weeks and then Wall Street reverses themselves, right? So the more information you have, yes, the more likely the momentum will continue for months at a time. But of course, you're also giving up a lot of potential gains by doing that. So there's always a sweet spot. So I would say that the DBC and underlying commodities is best looked at a 40 or more tailwind score. But then look and check buying pressure, number one. And if you see bullish or very bullish, and you see at least the intermediate forecast, bullish or very bullish, with no junior time frame warnings, like we're not seeing any heads up or danger warnings on that one, then you'll get things like the buy the dip signal or the bounce signal, which are very close. And you can go subscribe to cheat sheets, and there's a link that will take you to what all the trading signals mean. But that's a little bit of for example about why DBC looks better than it does here, because we would argue that this would be neutral minus between 40 and 50. It's really not. However, I think the relative position to all these other indexes is important. And what we're seeing here clearly is that there's nothing else, no other stock index here with buying pressure, no other bond index of the two that we're looking at. And the fact is that SHY, which is the shortest term look back I think we've got for an ETF on treasuries, this is 1 to 3 years. And then TLT, which is the 20-year note. What are you seeing? So bonds are terrible, which means interest rates are good right now, essentially.
High, yeah.
Yep. And so I wanted to come back to you. Was there anything else, any other comments you want to make about stocks? What we're looking at is basically the ACWI is about 40% US, about 60% rest of the world. It's all market cap weighted. It's the benchmark that basically gives you the measurement of the global economy. And at 33, what it's saying is that the long-term trends and forecasts are still okay, But underneath that, we're in an intermediate, at least, correction right now. And that's true of emerging markets. And it's true of developed markets outside of the US. That's what EFEA is. That's Europe, Far East, and Australia. And then the SPY, of course, the large cap US index. Again, still long-term okay, intermediate or worse, or lower, look out below. VEU is developed, it's basically the rest of the world market cap weighted without the US involved.
Yeah.
And then we have the Qs, IWM, and DIA, which are even worse, and then SHI and TLT. So I'm going to come back to you, and let's take a look at interest rates, because I think you're pretty good, and Advantage Mortgage, another company I recommend on Cheat Sheet's blog, is one that you actually pay attention to interest rates as a trader to help inform clients about tactical decisions about locking or not locking a rate right now.
Yeah, kind of a unique thing I try to do. Let me go back to.
I'm gonna pull you up now and take me off.
Okay.
And maybe you can dial up the interest rate stuff you look at. And again, remember, Cheat Sheet subscribers aren't advanced bond traders, so keep it simple.
Okay. Yeah, I mean, obviously, the last since that CPI report came out last week was horrible for yield if you were looking for
and what are we looking at right now? What's the CTF or this metric?
This is the TNX, which is a representation of the yield on the 10-year Treasury note.
Got it. So it's the interest rates on
the interest rate on the 10-year. Yeah, exactly.
So it looks like it's broken out of a range here recently.
It did. It broke out of, that above that 4.3 level, which has been an important level over time. It was above it back in the fall. So yeah, it did break out. It did, break outside the Bollinger Bands. It had a, probably a 2 standard deviation move last week.
It looks like that 4.3 index was resistance, or that interest rate, and it's now we think support.
Probably,
if we ever get back to it.
Probably will be support.
Yeah.
But it's also nearing overbought. If you look at the RSI here is in the 60s, so not quite overbought, but it's getting close.
Meaning short term, we might get a slight pullback in interest rates.
Right. That's right.
Okay. But the trend overall on an intermediate basis is higher.
Clearly. Yeah. The trend is clearly higher, and there's some important, levels that I'm personally watching above that I think that throughout the course of the year, yield is going to touch.
So if you're closing on the house in the next 2 months, you might say, hey, let's wait a few days before locking. We might get better rates as you look back. But my guess is that because everything's tied to the 10-year, right? The mortgage rates are.
Right.
Yeah.
Right.
So you'd probably be saying, hey, if we ever touch a 4.3 on the 10-year, let's lock.
That seems like a good place. If you're around 4.3 or lower, at least unless something big changes in the environment, yes, that seems like a good place to be.
And you're going to watch next week's data. You're going to watch the Fed meeting. You probably watched the data and blogged about it, what happened last week.
Yeah. Also, and I'm just, as you mentioned when we started, I'm really curious to see how the futures open later today, given the events of the weekend, because if there's a safety trade that's going to help this yield come down. If in fact traders perceive, a lot of danger in geopolitics, they're going to rotate into bonds, which is going to push bond price up and yield down. So I'm curious to see how that evolves over the next couple of days.
All right. So it's really interesting stuff. And what I wanted to do is just, I'm not going to revisit the S&P charts because you've done a good job of that. But I did want to come down here because we did talk about the DBC. And so what I have here this is a different type of report. This is a relative strength report. And I've come up with it's completely different than the tailwind metrics. You and I have been looking at charts like this for a decade now, right?
Yeah.
And I've been building this over time. And I think since you and I last chatted, I added something called a watch list grade. And so once again, for newer subscribers, I'm going to spend 2 minutes on this. For older subscribers that have this down, you can just fast forward the recording where I place it on YouTube. So the most important thing to understand is that we're ranking everything based on a 10-day look back period. And we're basically competitively ranking everything in terms of price performance, like who's gone up, who's gone down, and what does that mean in terms of relative strength. And so this is a relative strength trend measurement. But the most important place to look, well, there's two. One would be the average relative strength over the last 3 to 6 months. That would be the far column. This is telling you kind of on average during the critical 3 to 6 month calendar look back period. In other words, trends that have established and have been persistent. How are we ranking? So it might be surprising for folks to realize that silver has been doing so well lately, despite Friday's cool down, that it has a #1 rank on the 3 to 6 month look back period. It's pretty persistent no matter which period. When I say look back period, we're looking at price today compared to price X days ago. And then we're ranking that price performance relative to all of the other ETFs in the stack, including SPY and ACWI. So we threw in a couple of stocks here so you could kind of measure the price performance against everything else. And so one of the ways to look at this chart is to see how the average is doing, and then how you get two choices. One, where you're ranking at the shallowest look back period, 10 days. So it means we've gone first to first. But actually, I prefer a different way of looking at this. I actually like to look in the middle of the darker colored range of look back days, in the middle of the relative strength chart. So I pay most attention to the 120 to 60 day period. And if I see that we're relatively consistent and top ranked there, that's a good thing. It means that we have persistent strength against everything else in the stack. It means that institutions aren't bailing. And if it's been persistent the entire time, they're still acquiring. And so what you're really interested in would be transitions within that 60 to 120 day period, what I'll refer to from now on as the sweet spot. You know what that means? And these are trading days, not calendar days. And so when we look for transitions, we're looking at, like, for example, DBO, it's about 5 down. Average relative strength has been 10 within the sweet spot. But if you look at the 120 day period to the 60 day period, huge jump in relative strength, like a 14 to a 6. And we've stayed that way even in the shorter look back period. So this is a perfect example of something that's optimally rotating into favor. So that's the first place my eyes go. The second place is going to be the CMF, or Chaikin money flow, basically another way of saying buying pressure. We just say it differently on this report. But a 0.1 or higher means institutions are accumulating the stock. A 0.2 or higher, institutions are accumulating at a FOMO level, meaning they can't buy enough. And of course, you want to look at the money flow over time, just like you're looking at the relative strength over time. We don't do that here, although we can open this up and look, and sometimes I do look back 21 weeks and compare the 21-day CMF to the 21-week CMF. But a better thing to do is to put Chaikin money flow on your chart, because you do want to measure the persistency of money flow. But in general, the stuff in green and the stuff either transitioning through the sweet spot positively, bullishly, or maintaining strength bullishly in the sweet spot, those are the best candidates for trades. Now, we actually have automated some of this. A grade A watch list, we require not only that something be in the top 50% rank during the 3 to 6 month sweet spot period, but it must also be in the top 30% in the 60 to 10 day look back period. In other words, we need to see it in the top half of the ranker, and then we need to see it gaining strength in the most, the shortest time frame, the last 50 days. So top 50, top 30%, and money flow 0.2 or higher. If those three criteria get met, you get a grade A. So for example, and I think it's the DBO. It's actually that or the UGA. Can you tell? I'm just looking back over here.
I think it's the DBO.
Yeah. So the DBO gets an A rating. Persistent. I think I basically, So we transitioned through the sweet spot, have a 0.24 money flow, and we are in the top 30% in the last 50 days or so. So those three things conspire to give it an A. A B can work for you or against you. So in general, a B is good. The way we relax the rules on B is 0.1 money flow or higher. So it's a good thing if you're going from 0 to 0.1 money flow or higher. It's a bad thing if you were at 0.4 or 0.5 and you're down to 0.1. So you do need to have sort of a sense of where the money flow has been. And then obviously something can transition and be in the top 50% of the relative strength stack, but it could have started in the top 10% of the relative strength stack. So again, you want to look at the time-based chart on the left-hand side here and look for either persistent green, or you want to see a transition from red to green or yellow to green within the sweet spot. You get that, you get a good money flow number. It should be on your watch list as a potentially good place to be. And so with that as the background, these are the commodity charts. And I think they clearly spell, and they have been spelling for a while, that relative to stocks, you can see it was about 2 months ago, stocks started losing relative strength and losing money flow. We were, 6 to 8 weeks ago, double, we were seeing 0.2 money flows on SPY, and we were seeing persistent relative strength in the 1, 2, and 3 category. That's changed now. And you can see the SPY has rotated out of favor down to 9th within the sweet spot, 16th within the last 10 days. And money flow is actually now below 0.05, which we would consider light distribution, neutral minus, to get to a 0.05, a negative 0.05 or lower. Is there anything else you see within the commodity story that strikes you? Oil, definitely.
Gasoline,
look at that.
Yeah,
that transition seemed to happen before oil, didn't it? It's come down a little bit, but still nothing dangerous.
I mean, there's a seasonally favorable period for gasoline, which we're walking into. So, I mean, that could have something to do with it also. But yeah, gasoline jumped out at me.
Now, UNG has not been participating. We did have a little bit of a relative strength bump, but we don't really consider an isolated 10-day snapshot to be that meaningful.
Yeah.
But relative strength transitions have to start somewhere.
I mean, it's just looking at this and everything, the other charts you've shown, it's rotation, right? We're rotating out of equities, we're rotating out of tech and all the other things into commodities. Yep.
And bonds are paying well, even though we're not showing that here. We showed that on another chart.
Bonds are, yields are paying well.
The other thing is cost of food. So the DBA deals with futures contracts, but we also plug the ETF for corn in here, and corn doesn't show it quite yet. Starting to gain a little bit of strength here. Soybeans, not quite yet, but overall the DBA has been persistently high. And the money flow is in the FOMO level, right? This is a grade A.
Mm-hmm.
So top 50% in the sweet spot, top 30% on average over the last 50 days. Of course, we had one isolated week, but it's the average that matters. And then the money flow score. And of course, we look at the trends, but I think the trends are the least important metric on here. All right, so that's where we are as far as this goes. Is there anything else you wanted to show? I am going to set up to show some ETF recommendations that we had last week.
At the risk of jumping too far into the deep end of the pool, I did want to at least mention one thing to you.
Great. I'm going to put you back up on stage there.
See if you have any thoughts. Sorry. Let me change this. What do you make? And I mean, I have an opinion here, but the massive decline in the Japanese yen and its effects, obviously it plays a role on the value of the dollar. It plays a role on interest rates. I think it's a pretty important thing that isn't getting a lot of attention.
I actually prepared this because I agree with you, because the Japanese yen, what do we normally think of that as? When are people flying into the Japanese yen usually?
Well, I mean, the thing is, it has correlation with a lot of different things.
But it's a flight to safety.
Yeah.
That's where you go when you're panicked about stocks. Or a lot of institutions buy yen.
Yeah.
So I actually did some Money Flow Monday reporting that I think would be interesting for us to look at. You'll have to tell me if you can see the Money Flow Monday screen.
U.S. market conditions.
Yep.
Yes.
Yep. So we'll come back to this. This is tracking the tailwind score over time. This was published yesterday for those of you who are subscribers. We'll come back to this one because I want to point out a few things. But I wanted to take us down to that macro look. And I think I'm just looking for it. I don't think it's this one. This is going to be a whole bunch of, this is basically investing style relative strength transitions.
Yeah.
This is our futures contract that includes Japanese yen futures and some other things.
Okay.
So there you go. I was surprised by the the complete bearishness of the Japanese yen and the Swiss franc, because especially given the volatility, but Bitcoin seems to be despite what happened over the weekend, which this does not capture, but Bitcoin and gold, in terms of that relative store of value to fiat currencies, that seems to be working. And I'm just wondering, do you think it's Japan they're the kings of money printing? Well, the Chinese are the kings, Japanese are queens, and I guess we're the jacks of money printing.
We're all in the royal family, though.
But Japanese yen looks terrible. And there was even a heads up during the sell-off. So we almost got into that 5% danger zone on Friday.
Yeah, I know they've changed their monetary policies recently for the first time in a long time.
Oh, there it shows.
And so I'm not exactly sure to what degree that's playing a part in the decline of their currency.
Yep.
But I will note that the last time the Japanese government intervened in a declining yen was at the level was 152 yen to dollar, US dollar, and it's now at 153. So they've let it go
1.53 or 153.
153.
I haven't been to Japan, so I haven't traded currency.
So my point is that if there's any intervention, which seems overdue based on history, like the yen could get a little pop, which
so that would if they're buying yen, I guess the central bank would be purchasing yen,
their central bank would sell dollars and buy yen.
Got it. So that would impact DXY, our dollar index, and it would favorable to the yen,
and it would also impact treasury yields.
Interesting. Now, right now, the dollar is, and I think again, this is look back. The dollar is enjoying the fact that institutions are getting out of stocks. Not massively, but they're definitely selling positions here. And the dollar tends to do better, not necessarily in an inflationary environment. It tends to do worse then, but it tends to do better when the central bank is supporting the dollar. And clearly at 5+% interest rates, the dollar has been helped.
Oh, yeah. I mean, again, this whole thing just seems like a massive rotation to me.
Yep. So Bitcoin, though, has been the one that's been persistently. Now, of course, this is not Bitcoin. Oh, actually, this one is the Bitcoin futures. Now, normally when we're showing a BTC ETF, it's actually about Bitcoin adjacent currencies. When I last checked, there was no ETF yet approved to track the underlying futures contract for Bitcoin. Is that still true? If you know?
Again, I'm not a crypto expert, but
as of 30 days ago, it was true. I can tell you that emphatically.
Yeah, I don't think anything's changed in the last 30 days, but I could have missed that too.
But Bitcoin's been, some of the buying pressures come out of Bitcoin lately, and obviously over the weekend they might have puked it up. But gold, despite there's a big bearish engulfing pattern, meaning a bearish liquidation on Friday. According to this, though, it wasn't dangerous. We did not get I don't know if you want to look at your chart while I'm doing this. We did not get that warning sign. So I'm actually looking at trying to pick up some gold. If it bounces on Monday, even if it doesn't bounce, I might get into it. I just missed. I actually made a little money on gold, but I capped it with a call option by being an idiot. To be honest with you.
Yeah, I think there was a lot of things that happened on Friday that were just like a knee-jerk reaction to potential events of the weekend where people were just getting out of things for just to get out. And
gold and silver needed to pull back. They'd gone parabolic after their breakout. So I'm looking for. Timing is never going to be perfect, but gold and silver look great. And these are the futures contracts. So the tailwind score, remember what I said, if you're under 60, that's okay, as long as you have bullish or very bullish buying pressure and a bullish market forecast for the intermediate term. We have both of those things, so it makes my watch list. That's silver. That's the /SI, silver futures contract. The ETF is SLV. And then we have GC, which is the dollar futures contract.
Or gold.
But there's also a GLD ETF.
Yeah. GC is a gold futures.
Yeah. And then you also trade, for those of you who want to dabble in futures but get scared about the big sizes, you trade in a lot of micro futures, which are available like on the Tasty Trade platform.
Yeah. They require much less buying power.
Right.
I mean, they trade the exact same way, they trade around the clock and they trade the same way. It's a fraction of a contract.
So again, we are in what we would consider to be the optimal tailwind score for gold, 60 to 85%. You essentially know that the sum of the metrics, even though they're not all going to fall in line, enough of them are at the same time to where that is an optimal tailwind score. Your work is done. You don't need to microanalyze this. if you ever wanted, but if you were concerned that that 63 was reflective of something on the way down, you can confirm that by looking at buying pressure. Again, bullish or very bullish is what you want. And that intermediate forecast, you don't want it to tick to neutral, minus, or worse. So as long as you have those two things and a 60 to 85 tailwind score, we've done the work for you. You can then focus on timing your entry.
Yeah.
And I will show you that in this cheat sheet, we actually went through, and I think I did it. I think I might have done it on Friday's update. I don't think I have it here. Okay. I'm just looking to see if the GLD is not here. We do have these futures contracts. So we're showing you that silver looks great. The VIX, you can't really pay attention to VIX futures. You can't really pay attention to money flow. But I think the relative strength rotation does say a lot about the fear factor creeping up in VIX.
Friday was the highest level for the VIX of the year so far.
Yep. And all you need to be able to look at is the sweet spot, 11th to 5th, and we've sustained that up to number 2 in the most recent look back period. The look back period on the VIX, shorter timeframes do matter on VIX. That's the one where you don't trade a futures contract on a weeks to months basis generally, maybe a month or two. So you pay less attention to money flow on that one. You pay more attention when it comes to the VIX only. You pay attention to the trend, and it is now to the point where it is there's an intermediate fear factor going on here in the market. This is about as early warning and indicator as we have.
Yeah, and I mean it's been basing basically since late last year.
Yep.
And it's now breaking out above 15. So
yep. So I realize not everyone knows what these tickers mean. ES, we're 4th on average. This is the S&P 500 futures contract. It's just like the index. There's slight differences. And we've been 4th, 3rd, 4th, 3rd, 4th. And starting about 80 days ago, the first sign of weakness, it's actually more of the recent numbers are affecting the relative strength rank from 80 days ago. But the transition began, and now it's accelerating. And you also have the SPY or the ES under it's neutral at minus negative 0.02 money flow score. We start to get concerned about institutional liquidation at minus 0.05, but we're headed there. And then the other one is the Japanese yen. Look at the money flow score on that one. That is institutions cannot sell this fast enough. And they're probably shorting the yen and buying dollars.
But those moves like that, at some point, and timing is everything, and I certainly don't know the timing, but at some point, those things have to have a little bit of a bounce back.
Yep. And so and of course, AA is talking about a different type of trading than cheat sheets. Sure. We're looking at this as more of a macro investor thing, but what he likes to do is find the excesses and then trade the mean reversion.
Yeah.
Cheat sheets will be somewhat helpful for you there, but I think you just look at the charts for that type of trading.
Yeah.
So oil, gold, silver, dollar, although, still got some decent money flow as long as it's a stock market exit into cash. That will continue. As AA said, there's a lot of other factors that can impact the dollar. And then, of course, you have, I'm sorry, I don't even remember what 6J and 6S are.
6J is yen.
Okay.
6S.
Oh, yeah, that's what we talked about that just a second ago. And
know.
S is Swiss. I think the Swiss franc.
Okay, I forgot what that one was.
And then ZT is short-term treasuries.
Yeah, 2 years.
2-year note. And so that's interesting with the rates that it's offering. I guess we got a little bit of a bid on the last 10 days. But in general, the higher the rates go, the lower the futures contract goes. So in order to be a bullish interest rate trader, you'd be selling treasuries, right? In order to benefit from higher interest rates.
Yeah.
Or interest rates that will go higher, I should say.
Right, because that's basically what the statement is. If you're selling those, you believe rates will go higher and you don't want to be underwater on the note.
Yep. So finally, the last thing that I did, because it's Money Flow Monday, AA, is I went and looked for companies and I forgot to label them. So I'm not going to spend too much time on this one. I did make 2 picks that I wanted your thoughs about them. So obviously Energy XES, which is, you can find that in a more liquid ETF, but we use the S&P ETF indexes to be consistent. This is oil services. I think the OIH is more liquid. So these are companies that benefit from the drillers and other oil harvesters. They provide the underlying equipment that helps them get the oil both out of the ground and to market, right? Okay. And So we're at grade B there on XES. And then all of the rest of these are different types of ETF picks based on high money flow. Okay, that's the number one factor. But again, you want to look at money flow, relative strength transition from bearish to bullish or from neutral to bullish, and then obviously nothing grade A yet, because all of these ETFs are just rolling into favor or are rolling out of favor. I guess this is a hedged Japan ETF, but I made 2 picks.
Okay.
And there's your hedged Japan. So this is basically I think this is basically a short the yen play.
Okay.
And there's XES, not quite there on the tailwind score, but obviously that's coming. The rest of these, there's a lot of what I'll call hedged, volatility limited stock funds. So it's where they're selling a lot of call options against holdings in order to keep the volatility down. There were 2 that I liked. The first one was JBBB. It's a Janus fund that primarily invests in floating rate collateralized debt obligations, but they're moderate rated companies, not the A-rated stuff. And what they do is they buy their bullish interest rates. That's what this is, focusing on high yield
so
in the collateralized mortgage market.
It's corporate debt, right?
Corporate debt. You got it. Yep. And it's paying about 8% yield right now.
Okay.
And that's why I like it. And the other one is there's a kind of a lower volatility stock fund. So it basically gives you a range. You're not going to lose that much, but you're not going to gain that much either. I think this is a fancy way of calling it it's basically selling covered calls on bullish tech companies, but it's defensive. So it will cap your gains, but also protect against losses. So it's playing for outperformance of certain innovative tech companies.
Okay.
So it's a hedged way of playing an intermediate correction rather than this would certainly not be something you want to do if the Q breaks support and starts free falling.
And I'm unfamiliar with both of those, but I can only assume that you have to buy the shares. There's no options. There's not enough liquidity for anything like that.
Yeah, our rules when we make ETF selections is 100,000 average daily volume. They're unleveraged, so we don't get into any kind of leverage plays. And but they're multi-asset class. So normally I'll limit to stocks, but stocks aren't in favor right now. So this particular set of selections will include some fixed income. Mm-hmm. There's some, I think there's even some government muni bond funds in here. Okay. But then of these, I'd say XES would be a pick, but I've just covered it so often.
Yeah.
But anything attached to oil, gold, silver, metals and miners seem to work. And you can look at my Friday blog. I've put a lot out there, but Friday will give you the basic sectors and subsector market conditions as well.
I like it.
So that's a review. That was really helpful to have you on board to give us a chartered market technician lights point of view. But by the end of the year, you'll have that knocked out.
I hope so.
Are you studying hard these days? Or
Yeah.
are you taking a break?
No, I'm deep in it. I have my next exam coming up in June.
Yep. And this will be phase 2, correct?
Phase 2 in June, and then hopefully wrap it up in December.
Stock Cheat Sheets is available through Substack as a subscription. The market conditions email is always free, as are my ETF picks. We do ask for $5 a month or $50 a year in order to take advantage of our stock picks. And the reason for that is we actually take the time to do a fundamental analysis as well as a technical analysis on the stuff. And then our picks kind of marry the two together. So we're making sure that, for example, the total sales that the company brings in relative to its price is reasonable. So we're not picking overvalued stuff. We also right now are favoring companies that aren't drowning in debt, because their debt service is going to go up, we think. And then obviously the other thing we do is we're finding the strength in the market. So right now we're looking at gold miner picks, fixed income, metals and mining companies, oil services, oil exploration and production. It's basically anything involved with food that benefits from food costs going higher would be the other one. So it's people who are making food or farming food rather than buying food wholesale and trying to mark it up retail because we think they're going to get crushed.
Yeah.
Make sense?
Makes sense to me.
Go to stockcheatsheets.substack.com to subscribe. Pick up your free subscription or a 7-day trial to our annual subscription. That'll do it for us. Thanks for watching.
Thanks, Mike.